It's very interesting to start with the central banks because clearly what Chairman Powell said in the May FOMC and in a way reiterated yesterday is that they are risk adverse actually. Excluding the hike is just kind of removing a tail risk. The most important is about their intention. And one of the cornerstones of our view for this year is that they have actually very limited space for action. And you have seen that now Mr. Powell is talking about the risks of keeping policy too restrictive for too long. So yes, of course, it's one of the reasons behind the tech-driven rally, but it's not the only one. And anyway, we'll be waiting for the inflation numbers to see where they are going. But our scenario is still that they will cut twice this year, and we are reasonably confident. Anyway, they don't have a huge leeway for action again.
Indeed, and you mentioned it right there. US CPI coming in tonight. Do you think equity markets have a bias to rally if we saw inflation, confirmation that inflation is indeed cooling as the Fed has suggested?
That's absolutely the right way to ask the question, because what matters is not just the number, it's the number and the market reaction, which will tell us a lot about how people are actually positioned and what they expect. So yeah, the core CPI and well, both the headline and the core are expected to moderate on a year-on-year basis, but they are still too high. We're talking about 3.8% for the core CPI. What will matter as well is to look at it with the retail sales, because if you have a slightly worse than expected inflation number but lower retail sales, people will definitely look through it. And again, after the May FOMC and the kind of change in narrative towards risk aversion from the central banks, I think that it would take a big surprise to really reignite big fears from the market. So even if it's a bit higher, the issue would be a higher inflation and higher retail sales. In this case, we would see some impact on rates and equities would be volatile. But still, we expect volatility anyway, and we think that we are still in a kind of a disinflation mode because we see signs of softness in the US job market, which means that prices in services, which are the next shoe to drop, should at least stop rising.